So when this bubble breaks, and we think it's about to really break in a way that is like headline gathering, and it could very well show itself in the next few weeks, I think that's...
You're watching Silver News Daily. Subscribe for more.
Michael Oliver, a renowned market analyst, just made a shocking prediction that could change the game for silver investors. He believes that silver could skyrocket beyond $50 per ounce. I know it sounds crazy, right? But before you dismiss this as just another wild speculation, stay with me for a few minutes. In this video, we're going to break down exactly why Oliver thinks silver is on the verge of a massive breakout and what it means for stackers like you. We'll uncover the critical factors driving this prediction, and trust me, you don't want to miss this. So grab your notepad and let's dive into why now might be the best time to stack silver before it's too late.
Silver and hourly gold, they rallied on the news, then they collapsed on the news. Okay, it's noise. Okay, there's bigger stuff going on. First off, the markets don't go together. Gold and silver, T-bonds, so forth. T-bonds, for example, sold off also. Well, our assessment of the major trends is that T-bonds have now joined gold on the upside in a major advance. Okay, T-bonds are likely to surge, drop in yields for the next several quarters. That occurred a month or so ago. They broke out over a major, what we call a quarterly momentum base. See it on momentum, not on price. Gold already broke out in late March, so did silver, so did gold miners. Then they paused recently and then surged to a new high today. Miners got over 40 on GDX, for example. Gold touched 2,600 on the front month contract, October. And the S&P had a surge as well today as soon as the news came out, and then the sellers came in on all the markets. So unless you think they're all going together at the same time in the same way, today is noise. Okay. Now, there's some big stuff going on here that is opposite. Okay. We think gold and silver are going to continue higher. Today's wobble doesn't impact us one bit in terms of our assessment. We think the stock market is topping and has a very, very dangerous situation below it that could easily come into play next month, meaning starting in a week or two. And the T-bond market pullback is meaningless. The T-bonds are in a fresh upside mode, meaning asset managers this time around have viewed T-bonds as a place to be other than the stock market, just as they've viewed gold miners to be that way. So anyway, I would ignore today. That's my technical assessment.
Now, let's rewind a bit and look at how silver has behaved during some of the most turbulent times in financial history. Back in 2008, during the global financial crisis, silver surged as investors scrambled for safe haven assets. The same thing happened in the early 1980s and even during the 1987 market crash. Each time the economy faltered, silver shined bright, delivering massive gains to those who had the foresight to invest. With market analysts now predicting a potential economic downturn, could we be on the brink of another silver rally? Michael Oliver's analysis suggests that we are. He points out that, just like in those past events, we're seeing early signs of a market correction. And if history is any guide, this could mean a major opportunity for silver investors. So the question is, will silver follow its historical trend and explode once again? Let's dig deeper to understand what's happening right now and why this time could be different.
Process of correction in gold and silver that occurred after their surge in March and April. In the case of silver, March, April, and May, silver continued up a month beyond gold. Then we entered a multi-month correction in silver with some downside pain. And for gold, basically a yawn sideways in about $100 range, just up, down, up, the noise, in other words. But a congestion period where the gains that we saw, dramatic gains in about a 6-week period in March, April into May, corrected. And we had a pause, profit taking, shorts came in, doubted the market, et cetera. We think that ended last week's action, ended that process. In the case of silver, silver went up. If you measure from the low of last week to the high, was over a 10% upturn, literally within a week. Okay. Gold had a little bit more than a 4% upturn from its low of the week to its high of the week. So they both said, I'm out of here. Okay. The congestion process that we saw, multi-month process, we think is over now. Now the question is more dynamics on the upside, and I think it's coming. Today is noise. Ignore today. I don't think today disproves that argument whatsoever. In the case of the stock market, we have a situation that is, I don't want to pound the table yet, but in 1987, I caught the crash. I was a broker at the time, independent broker, and I caught it in a small way with puts. Okay. I didn't make a fortune, but I made a huge percent gain in a very short period of time with some puts. And it taught me a lesson because what I did it based on was quarterly momentum of the S&P 500, not its price action. Price action of the S&P looked just like it does now, just upward, pull back, upward, pull, just happy market going all the way, going to go forever, you know. You pull back a little bit in early October, the new quarter in 1987, and though price didn't pull back in any meaningful way, when you looked at the price chart, you weren't breaking a thing. Quarterly momentum was blowing a floor that had established over a 2-year period, where if you looked at the quarterly momentum, it just kept coming back to the same horizontal level over and over, and finally in early October broke it, and you crashed. It was a surprise that nobody caught. It was a panic beyond panics. It happened back then. I've gone back and researched it. Gold was in a non-trending situation then, really. But gold during that bad week went up 7%. So somebody didn't tell gold it was supposed to go down if the stock market crashed. Anyway, keep that in mind. Because I know everybody thinks that if you ever get an event like that in the stock market again, and we have the setup for it now, I'm not saying it's going to get triggered, but it's about 4% below where the NASDAQ 100 is right now next month. You don't want to be there. That therefore silver and gold must go down. And I think it's going to be a very interesting hypothesis because factors have changed, technical dynamics have changed, and I don't think that's going to happen. And if you think it's going to happen and you're long silver and gold, then I suggest you better buy some puts on the S&P if our trigger numbers are hit. Okay. Anyway, I think we're about to move into very dynamic markets.
All right, let's talk about the current economic landscape and why it has everyone buzzing about precious metals. Recently, the Federal Reserve made headlines with a surprising 0.5% interest rate cut. Now, typically, lower interest rates are meant to boost the economy by making borrowing cheaper. But here's the catch. Every time the Fed cuts rates, it also devalues the dollar. And when the value of the dollar drops, what do people turn to? That's right, hard assets like gold and silver. Add to that the ongoing geopolitical tensions, market volatility, and concerns over inflation. And it's no wonder that investors are flocking to safe haven assets. But silver has a unique edge over gold right now. Not only is it more affordable, but it also has a growing industrial demand, especially in tech and renewable energy sectors. So, while gold often gets all the attention, it's silver that might just be the dark horse ready to take off. But how does this tie into Michael Oliver's prediction? Let's get into the nitty-gritty of his market analysis next.
Enough examples in history to make the case that this is a recurring event, okay? There is one distinct example everybody really remembers, and that's October of 2008, when the stock market had already been in bear trend for over a year, and it sharply declined already. And then in October, it had a puke month where it went down like 30% real quick. At that point in time, though, silver and gold had been advancing as the stock market bear had been underway for a year. They had been advancing. And when you looked at silver and gold's technicals at that point, they justified a sell-off that happened to be coincident with the stock market. In other words, they needed a correction. We could see it on the charts that it looked like they were going to be vulnerable too. We do not have that situation now.
Now, let's dive into Michael Oliver's market analysis, which has everyone talking. Oliver, known for his expertise in momentum structural analysis, believes that silver has recently broken through key momentum levels. But what does this really mean? Well, in simple terms, These momentum levels are like invisible barriers that, once crossed, signal a strong potential for an upward trend. And guess what? Silver has not only broken through one but several of these levels in the past few weeks. According to Oliver, this breakthrough is a strong indicator that silver is entering a bullish phase. He points out that similar momentum shifts happened just before previous silver rallies in 2010 and 2016, leading to massive price surges. He also notes that we're currently seeing unprecedented buying interest from both institutional and retail investors, further fueling this bullish trend. This isn't just speculation. The charts and market behavior are backing up his claims. But here's the kicker. Oliver suggests that this is just the beginning. If silver continues on this path and breaks above its recent highs, we could see a rapid ascent to levels not seen in nearly a decade. So, what could be driving this surge, and how high could silver go? Stay tuned as we explore his price predictions and the potential catalysts for this explosive growth.
The Fed funds days, you go back and look at them and circle them, go back to last year. And then when you get these rate rises, or then you get the pause, or then you get, quite often it's noise. It's not ultimately determines the trend, okay? And a lot of people like to pin it on that. Today was a bit of surprise, not much, in that everybody knew the rate cut was coming, okay? Back in 2007, same week in September 2007, the Fed cut rates by 0.5 point, and it shocked everybody. It was the first rate cut in a couple of years, and nobody expected it. So it was an ambush. And the stock market shot up for the next about 3 weeks. It went up another 7% in the S&P, and then it topped and it went into a massive bear market. So the Fed cut rates for the next couple of years even, and it didn't matter. The bubble was broken. The market went down. They could cut rates. It didn't matter. But this time it's different in that we've known they're going to cut rates. They've said so. So the rate cut itself is not a surprise. It was a bit of surprise that it was 0.5 point, given that Powell assures us in his patronly manner, his fatherly manner, that the economy's in good shape. So, well, why the hell did you cut rates by 0.5 point? So anyway, so some economists were actually a bit upset by that, in that they thought, well, that's what does that mean, Fed? If everything's so good and we think everything's so good, why did you cut by 0.5 point? So that probably concerns some people today, justifiably. We see that the situation now is different, though, in that the bubble in the stock market is the biggest in our history. No stock market has had a 15-year bull trend. It's amounted to 7-8-fold increase in the S&P and a 17-fold increase in the NASDAQ 100. No bull market prior to that, not the 29 top, not the 1970s peak, not the 2007 peak, not the dot-com top. None of them matched the extremity of this bubble. And it's easily explainable. You look at a Fed funds rate chart, money was free for about a decade. What do you want? The money went somewhere, okay? And it helped create a bubble. But the other side of that is when the Fed does decide finally to alter policy, it's never helped in those bear markets either. In January of 2001, for example, 6 months off the high, the dot-com high, the Fed cut rates twice the first day of January and late in that same month, literally 6 months off the high. We weren't even in a bear market then. And the market continued to collapse for 2 more years, big time. And they cut rates all the way down. 2007, they cut rates in September, market peaked 3 weeks later, they cut rates all the way down. The bubble continued to break. That back then it was mortgage-based. Prior to that, it had been the dot-com. Now it's many things. It's not AI. AI is only the recent headline. It's a lot of factors in play here. So when this bubble breaks, and we think it's about to really break in a way that is like headline gathering, and it could very well show itself in the next few weeks, I think that's going to panic the central banks, not just the Fed, into all those things that they do to degrade the underlying value of the money unit ultimately is the consequence, and that ultimately is what drives gold in the long run.
Let's break down Oliver's bold price predictions for silver. He suggests that a silver can break through the crucial resistance level of $32 per ounce it could quickly shoot up to $1.50 or even higher. Now, why $1.32? According to his analysis, this level has acted as a major ceiling for silver in the past, and breaking it would signal a massive shift in market dynamics. Imagine it as a dam about to burst. Once silver crosses this point, the pent-up demand and momentum could propel it to new heights. But that's not all. Oliver goes even further to say that under the right conditions, such as continued economic instability, a weaker dollar, and increased industrial demand, silver could climb as high as $1.60 or more. That's a potential increase of over 80% from current prices. Such a surge would be unprecedented, but Oliver believes that the fundamentals are lining up perfectly for this scenario. Now, I know this sounds incredible, but think about it. Central banks are hoarding gold, inflation is on the rise, and silver is historically undervalued compared to gold. These are the perfect ingredients for a potential silver boom. But is it really possible, or is this just wishful thinking? Let's explore why stackers like you need to pay attention and act fast before this window of opportunity closes.
I think that, yeah, one, nobody expects a market decline now of significance, okay, especially anything rapid. I think that would ambush everybody if that happened. We think the potential is there. We'll be very specific in our reports over the next week or two, especially as we get into next quarter, because our numbers shift then. It's a new quarter, new numbers change. And the vulnerability gets very clear at that point. If the market even sneezes, it could blow the bottom out of it, which would ambush a lot of people, probably even political people, because one side would not like that event, okay, if that happened prior to the election. If people are already in pain due to this or that factor, including higher prices and so forth for basic materials and goods, if their retirement account suddenly shed 20-30% rapidly, the pain would be horrific. But anyway, the Fed is obviously concerned about something. They have justification for being so, even though they never admit it. And I think gold and silver have known this all along, that ultimately the central bank is going to go berserk to defend this breaking bubble. And they're ahead of the game. Gold's not waiting for the bubble to break and the Fed to respond. It knows it's coming. And I think that's where we are right now.
All right, so why should silver stackers act fast? Let's get into it. We've talked about the historical trends, the current economic conditions, and Oliver's technical analysis, all pointing towards a potential breakout for silver. But here's the thing. The silver market is incredibly tight right now. Unlike gold, the silver market is much smaller, meaning even a relatively small increase in demand can send prices skyrocketing. On top of that, we're seeing a surge in industrial demand for silver, especially in sectors like electronics, solar energy, and electric vehicles. This isn't just about stacking for investment. It's about real-world usage driving up demand. And with supply constraints already in play, any spike in investor interest could create the perfect storm for a rapid price increase. Oliver emphasizes that timing is everything. Once silver breaks through that $1.32 barrier, it could be off to the races, and those who wait might miss out on the biggest gains. He advises stackers to keep a close eye on the market and be ready to move when the time is right. The window of opportunity could close faster than you think. So, are you prepared to take advantage of this potential surge, or will you be left on the sidelines watching silver prices soar? Speaking of action, what's your take on this situation? Do you think silver will break out as Oliver predicts, or do you see it staying below the key resistance level? Let's discuss in the comments below.
And GDX did today as well, the gold mining sector. It had stopped short of 40 repeatedly, and it blew over 40 today. Now, they sold it off, yes, along with they sold everything today. Ignore that. But it did make new highs today, too. And silver was back up to 31.5, not far from its highs. Its prior peaks in silver in May, which was much higher than gold's peak in May. Gold peaked in April, and silver went on up into May. Silver got above 32 then and dropped back down to about 29. And it got above 32 again in, I think, July, and then you had the big sell-off into August. It got down close to 26, so really a deep cleansing. And you came up off that low pretty rapidly, and last week you were down to about 28. Next thing you knew, you're 31. Boom. So silver and gold have declared that process is over. The issue now is what's on the other side of this, and I think it's going to be very dramatic. We've got some tentative numbers that we're paying a bit of attention to. They're not a top. We don't expect a top in gold and silver. We don't think we're in 1980 in gold where you peak, or in 2011. We don't think we're in that situation whatsoever. We think it's likely to continue for another year or so. But in the immediate run, we could see a dramatic surge. And I think that the dramatic surge, for example, if you get silver back to 32 a third time, now think about this. If you're a point and figure guy, you keep it X's and O's, upticks or X's, downticks or O's. You went up to 32, back to 29, downticks, back to 32, double peak, dropped down and took out the 29 low and went to almost 26. So the point and figure chart broke down, cleared itself out, and shot back up now to 31. You ever touch 32 again? That's what you call a pending triple top breakout. And I bet you touch 32, you're not going to stop. You're going to blow through. I think the surge in silver could carry us well over 50 rapidly. Now, that sounds ludicrous. Well, right now, there are some brokers out there, big brokerage firms, that are talking 3,000. That makes me a little nervous because, frankly, that's sort of a minimal pause point for us. So let's just assume gold in this surge is going to go to 3,000, which is another $400 beyond where we've reached today. Okay. If silver, during that same process, were to take its spread relationship to gold, which is now above 1.2 and pressing toward 1.3, if it were to go to 2%, which if you go back over the last 50 years and look at the silver gold spread, price of silver expressed as a percent of gold, you'll see there are many, many years in that 50-year time where we reach 2%, 2.5%, even 3%. Okay, so it's not abnormal. If silver merely went to 2% again, which again is a level we've seen so many times in the last decade, for example, it's ridiculous. It's normal. Silver would be $60 if gold were 3,000. So I think that silver's dual highs that everybody knows about at $50. We get up through this recent stuff, we've been up to 32 again, and blow through that. I think that surge could carry you up into the mid 50s at least, well beyond the $50 peaks that everybody knows about. And I think that's the potential for this pending surge that I think we're on the doorstep of.
Now, let's bring it all together. If Michael Oliver's predictions are accurate, we're on the verge of a massive opportunity in the silver market. The technical indicators, economic factors, and growing industrial demand all point to a potential breakout. Imagine silver is shooting up past $50, maybe even reaching $60 or more, as global uncertainty pushes more and more investors into safe haven assets. This isn't just a wild guess, it's a scenario backed by solid analysis and historical patterns. But let's be clear, while this potential is exciting, it's also highly speculative. The silver market is notoriously volatile, and nothing is guaranteed. However, for those willing to take on the risk, the rewards could be substantial. Just think of what it would mean for your portfolio if silver did make such a move. That's why Oliver is urging stackers to be prepared, to stay informed, and to act swiftly if this breakout begins. Before we wrap up, remember this is not financial advice. It's crucial to do your own research and consult with a financial advisor before making any investment decisions. But if you're intrigued by the possibilities in the silver market, now is the time to keep your eyes open and your strategies ready. Don't wait until it's too late. Subscribe to stay updated on all the latest developments and join the discussion in the comments below. What do you think? Will silver skyrocket, or is it all just hype? Let's hear your thoughts.